Well, there's really two types of important investment risk out there that we want to talk about today. So on the one hand, you have the short-term volatility of the stock market, that type of risk. And on the other hand, you have the long-term risk of running out of your money. In other words, outliving your money. So the cause of the volatility in your portfolio is from having stocks in your portfolio, typically. And the cause of running out of money over the long run is from having too few stocks in your portfolio. So we have this sort of tug of war here. And the balance lies in really having the right mix between stocks and bonds. See, if you have too much stocks in your portfolio, you're going to experience a lot of volatility. And what we're talking about when we say volatility, of course, is ups and downs. And what we're really concerned about are the downs. And if you experience a down market such as in 2008, the latter part of 2008, early 2009, you might panic out in that case if you have too much stock exposure. You might sell at the bottom, and you're just not going to achieve your goals if you do that. Okay. On the other hand, if you have too few stocks in your portfolio, then your portfolio is going to have basically a fixed income behavior to it. It's going to be basically a bond portfolio kind of kicking off a fixed income for you. And, well, you're not going to achieve your goals that way because goals typically rise with inflation or even faster than inflation. And the only way to achieve your goals is to have growth in your portfolio. So you can't get away with having too few stocks. So, again, you have to find this right mix between the stock allocation and the bond allocation in your portfolio.
Now, investors, whether they are individuals or professionals, are notoriously poor market timers. Right? The biggest mistake is moving into bonds when times are bad, such as 2008 that Darius alluded to, or moving too much money into stocks when the times are good, when you've already missed that run-up in the market. It's the same as buying high and selling low, the exact opposite of what we should be doing. But that's just not how our brains are programmed. Right? This is a very reactive strategy that consistently dooms investors. The good news is there's no need to do this. Right? If you can establish a financial plan that lays out your proper mixture of stocks and bonds, then with enough of your assets and bonds, you can ride out those really predictable, unpredictable market dips. Right? That'll help you sleep at night, knowing that despite the fact your stocks are going down, you have the assets there to help you wait out that recovery. And that recovery always comes. Right? Now, at the same time, investment in stocks is what enables you to generate the growth in your money needed to outpace inflation and enable your money to provide for you for the rest of your life.